I'm going to tell you how we utilize capital loss harvesting as a way to realize some future tax benefits and savings. What is a capital loss? Well, it's when you buy an investment and you sell it for less than what you bought it for. So think about your investments. Some days they go up, some days they go down. You don't actually realize a gain or a loss until you sell that investment. Just because something is less than what you bought it for doesn't mean it'll end up staying less than what you bought it for. But if you realize that loss by selling that investment, then it turns into a capital loss. What are the benefits of a capital loss? A capital loss provides us with a couple different strategies and ways to generate some tax savings. The first of those is to offset a large gain. For example, if you have an investment that you've held on to for the last 5 or 10 years, let's say, and that value has gone up to $50,000, you bought something at $10,000, now it's worth $60,000, you're technically sitting on a capital gain of $50,000. Now, maybe you haven't realized that gain yet. However, when you do, there will be some kind of tax consequence. And in order to lower that tax consequence, we can sell some investments that maybe haven't done so well to offset some of that gain. So let's say you have another investment that you bought at $10,000 and right now it's worth $1,000. So it's gone down $9,000. Now, if we go and sell $50,000 worth of capital gain from your previous investment, and now we realize against that a $9,000 loss, well, technically then on paper, you will have a $41,000 capital gain instead of a $50,000 capital gain. And so it provides us with a way to create some tax savings because we've actually saved $9,000 in taxes because we've used the loss to offset that gain. Now, I know you're sitting there thinking, well, Nick, I actually lost money, so that's not a really nice way to generate some income for me. Well, no, it's not, right? The idea is utilizing strategies that we have today based on what's going on around us. So it's not to say that we just take that money and run to the bank. We can realize that loss and reinvest it or start to invest it again immediately so that the loss is basically generated on paper and it allows you to get into the market and not stay out. So as things recover, hopefully that investment recovers and will continue to go back up, generating, again, a capital gain in the long run. Now, there's also the added benefit of this that allows us to rebalance your account. So in some cases, it becomes troublesome that there may be some positions or some investments that we got a lot of exposure to because the investment has just done really well and we don't want you to realize that capital gain yet. So by selling some things to offset some gains, it allows us to rebalance and make sure that the allocation that we've talked about is the proper allocation that we've had and want to have going forward. So the second strategy that you can utilize with capital loss harvesting is to offset future capital gains. What do I mean by that? You can use capital loss indefinitely into the future. So let's take an example. If you have $10,000 worth of capital losses, the IRS will only allow you to take $3,000 of that loss per year. Now, maybe next year you would like to realize a huge capital gain, let's say $50,000. Well, if you've only used $3,000 of that capital loss, you still have $10,000 of that loss that you can carry forward into another year, in this example, next year, to offset that capital gain. So again, $50,000, you can now use $7,000 of that loss that you took this year to offset against that, leaving you with only $43,000 worth of capital gain. So you've saved on some taxes by avoiding $7,000 worth. This allows us to take losses today, stay invested, and continue to bank those losses for future years. So when does this apply? It doesn't apply to your retirement accounts. So think of your 401ks, your IRAs, your Roth IRAs. Those are all sheltered, it's what we call qualified accounts, meaning you either paid some tax for the money before it went in, or you're paying some tax when the money comes out of those accounts. So we can buy and sell within those accounts without having a tax consequence, because the tax consequence doesn't occur until you take the money out or put the money in. So what I'm strictly talking about is this type of strategy applies to your brokerage accounts, your joint accounts, your trust accounts, the type of accounts that aren't in as a retirement plan type of account, what we call as non-qualified accounts. This is where this scenario would apply to those types of accounts. And when do we want to utilize these types of strategy in those types of accounts? Well, it's going to be when you're in higher brackets. So think of if you're in the 22% bracket and above, these become nice strategies to utilize because your income is most likely higher, and using something like this will get you some tax savings. The one caveat for capital gains and losses is that they fall under a separate tax bracket, 0, 15, or 20%, depending on where you fall for the income tax brackets for the year. So there are still some little caveats to this, but in a general sense, it can work really well if you're in a higher bracket to offset some of those future gains to get you down into either a lower bracket situation or to just realize some gains when you're in a lower tax situation. And lastly, if you anticipate being in a higher bracket in the next couple of years, by banking some of these losses, again, this will help to offset some of that future income or even some future gains that you want to realize so that you have this tax savings going forward. So you may or may not realize it, but this is what we're doing as we're managing your investment accounts. And this, to us, is one added benefit of having an advisor, is making sure that you're not buying and selling things that are going to create or mess up your tax situation. So that's why when we go in and manage your accounts, we want to make sure we're looking at these things to maximize the tax savings for you now and going forward. So if you have any question about your specific account and what you should be doing, please let us know. We'd be happy to review that with you. But again, these are things that we're doing given this type of market environment. We know we still got some choppiness to coming up and down the road. So we just say, stay calm and control the things that you can control, which are spending and savings. Continue to invest for the long haul and don't get worried and caught up in some of the short term. So if you found this video helpful, if you liked the podcast, make sure you give it a thumbs up, hit the subscribe button, share with your friends. And of course, have a great day and the rest of your weekend. Take care.